Hello everyone, welcome to my channel Unlock Your Finance. Today I am going to talk about how you can pay zero tax if your take-home salary is up to 10.5 lakhs without having to take any home loan. I will convince you by the end of this video why planning tax efficiently is very important. Some might say, just choose the new tax regime and forget it. But let me tell you, if your salary is 10.5 lakhs, you would have to pay 62,400 as income tax. You can choose what to do after watching the whole video. First and the most popular category of deductions is 80C deductions. Under 80C, the maximum limit of deduction is 1,50,000. Your company is already deducting 12% of your basic salary per year as Employee Provident Fund, which comes under 80C deductions. After deducting EPF from 1,50,000, you can invest the remaining amount in PPF, VPF or tax-free mutual funds. Among other instruments, I've chosen this so that you don't end up compromising on your returns. The yearly premium you pay towards life insurance policy also comes under this section. On your screen, you can see a list of instruments where you can invest to take 80C deductions. Next is section 80CCD, which relates to the deductions available to individuals against contributions made to the National Pension Scheme or the Atal Pension Yojana scheme. Under 80CCD1, you can claim an additional amount of 50,000 on top of 1,50,000 you were getting in 80C. So the allowed deductions becomes 2 lakhs. Under section 80CCD2, your employer can invest additional 10% of your basic salary in NPS. This will be over and top of your 2 lakhs which you were getting in 80C and 80CCD1. Say your basic salary is 5 lakhs. You can take deduction of additional 50,000 under 80CCD2, which is 10% of 5 lakhs. Hence your deduction becomes 2,50,000 in this case. Next is section 80D, where the limit can be anywhere between 25,000 to 1 lakh. If you are buying medical insurance for yourself, your spouse and your children, the maximum limit here is 25,000. Whatever premium you pay, you can deduct that under section 80D. If you are buying medical insurance for your parents who are not yet senior citizens, you can claim an additional 25,000. In that case, the limit becomes 50,000. If they are senior citizens, you can claim up to 50,000 for them and your deduction limit becomes 75,000. If both you and your parents are senior citizens, then it will be 50,000 for you and 50,000 for your parents. In that case, the upper limit becomes 1 lakh. However, I have considered 50,000 as the total premium you are paying, including your parents. But it will be definitely more if they fall under the senior citizen category. Then we have HRA or House Rent Allowance. This falls in exemptions under section 10 of income tax. To calculate HRA, we take the minimum of 3 calculations. Let me give you an example to make this simple. Consider the following scenario. Raghav lives in Bangalore, which is a non-metro city. He receives HRA of 1.6 lakh from his employer. His basic salary for the year is 5 lakhs. Further, he pays a monthly rent of Rs 20,000. What is the quantum of HRA exemption he can claim? The first thing we see here is HRA received from the employer is 1,60,000. Second, actual rent paid minus 10% of his salary would make it 2,40,000 minus 50,000, so 1,90,000. 50% of basic salary for those living in metro cities and 40% of basic salary for those living in non-metro cities. In this case, we take 40%, which makes it 2 lakhs. Hence, Raghav will have to pay 1,60,000 since it is the least of the 3. Then we have an exemption which is much less talked about but can be very effective. I am talking about LTA or Leave Travel Allowance. You can claim LTA for travel costs incurred for yourself and your family. When I say family, it is your spouse, children, wholly or mainly dependent siblings and parents. Please note, the exemption is available only on the actual travel cost, that is the air or bus fare incurred by the employer. LTA exemption is available for only 2 domestic journeys performed in a block of 4 calendar years. The current block year, as on the time of recording this video, is 2022-2025. The amount of LTA exemption depends on the LTA component in your compensation package or CTC. I will take a realistic assumption of 50,000 for our case. Out of the 10.5 lakhs net salary, we got a deduction of 2,50,000 from ATC, ATC CD1 and ATC CD2, which reduces the taxable salary to 8 lakhs. From ATD, we have taken 50,000, so it further reduces to 7.5 lakhs. Finally, from HRA and LTA, we are getting 1.6 lakhs plus 50,000. Hence, an additional deduction of 2,10,000 from your taxable salary. Hence, your taxable salary becomes 5,40,000. Going by the old regime, you will have to pay a tax of 21,000. Don't be disappointed yet. From annual year 2020-2021, we have a standard deduction of rupees 50,000. Hence, the taxable salary comes down to 4,90,000. If your taxable salary is less than 5 lakhs, we get a tax rebate. Hence, your tax liability becomes zero. As promised, I didn't take home loan interest deduction, but in case you have one, you can leverage that to pay zero tax even on a salary up to 12.5 lakhs. Let me know in the comments if you want a detailed video on NPS. Feel free to post your questions. I will get back to you. Do give a thumbs up if you have found this video helpful. Share it within your network and subscribe to my channel for more such content. See you in my next video. Bye bye.